A retired couple came to me with what seemed like a straightforward question. They had two mortgages, one of them an adjustable rate loan that had just gone up and was about to go up again. A bank stepped in with an offer to consolidate everything into one fixed rate loan, a lower payment, no arm risk, clean and simple. On paper, it looked like a no brainer, but when we looked at the full picture, the right answer wasn't the refi at all. It was something they hadn't even considered yet. I'm Jerry Bulaclac, financial advisor at Radiant Vest and fiduciary, which means I'm legally required to put your interests first in everything I do. I've been working with pre-retirees since 2005, and one of the most common situations I encounter is a family facing a major financial decision where the obvious answer and the right answer turn out to be two different things. Today, I'm walking you through a real-world scenario that came across my desk. By the end of this video, you'll have a clear understanding for how to think about housing decisions in retirement, why a bank's offer may solve the bank's problem more than yours, and what the equity math may actually reveal when you look at the full picture. Some of you may be thinking, Jerry, I'll never have two mortgages in retirement, and that's entirely fair. But here's the thing. The decision-making framework in this case study applies to almost every major financial decision in retirement. A refinance, a home sale, a relocation, a lump sum offer. The pattern of this offer looks good on the surface, is one of the most common situations I see, and the families who tend to navigate it best are the ones who know what questions to ask before they say yes. Before we dive in, quick but important note, this video is for educational purposes only. The scenario I'm walking you through is a hypothetical illustration based on real-world situations. It is not personalized financial advice, and individual circumstances vary significantly. Please consult a qualified financial professional before making any major financial decisions. Here's what makes this case study worth your time. The bank's offer wasn't wrong. It actually made sense. What changed the entire conversation was one number, a number hiding in plain sight that most families never think to put on the table. That's what we're uncovering today. Let me introduce you to Fred and Betty, a hypothetical couple in their mid-70s. Fred is 75, Betty is 74. They've been in their home for years, and from an income standpoint, they're actually in a strong position. But they have two mortgages, one of which is an adjustable rate loan that just jumped to 6.25%, with the payment heading from $2,100 a month up to $2,400. Their second mortgage has $44,000 left at a fixed rate with a $350 per month payment. Total housing payment right now, about $2,750 a month. The bank offered to consolidate both into a single $231,000 loan at 6% fixed, monthly payment of about $2,460. That's lower than where they're headed. The arm risk disappears. So, should they do it? Before we answer that, let's look at the full income picture because this is where context changes everything. Fred has Social Security of about $3,500 a month plus a pension of about $2,500 a month. Betty has Social Security of $2,500 a month. Total guaranteed monthly income, $8,500 a month. That's not income coming from the market. That's not a portfolio withdrawal. That's guaranteed every single month, regardless of what the stock market does. Now, let's look at what they're spending outside of housing. General living expenses run about $13,000 a year. They like to travel, so that puts them at somewhere between $5,000 and $10,000 a year for travel. So total non-housing expenses, roughly $18,000 to $23,000 a year. That's about $1,500 to $1,900 a month. Even at the high end of non-housing expenses, they still have over $6,600 a month left from income before a single dollar goes to housing costs. This couple is not cash flow poor, and that's the first thing that tells me the mortgage question may be the wrong question entirely. By the way, if you want to run this kind of income versus expense snapshot for your own situation, I have our Radiant Vest retirement calculator linked in the description below. It takes about 5 minutes and gives you a clear picture of where you stand. Link is below. It's complimentary. So back to the bank's offer. I want to be clear. On its own terms, it's not a bad offer. A fixed rate eliminates the arm risk. One payment is simpler than two, and $24.60 a month is lower than where their first mortgage alone was heading. But here's the question I always come back to in situations like this. Whose problem is this offer solving? The bank's or Fred and Betty's? Because when I look at the full picture, there are three things about this refi that tend to give me pause. First, the age math. A 30-year mortgage at age 75. This loan pays off when Fred is 105. That's not a mortgage. That's an obligation that may well outlive them. Second, the house itself. 3,000 square feet is a significant amount of home to maintain in your mid-70s. Beyond the mortgage payment, there's upkeep, property taxes, insurance, and the physical demands of managing a large property over time. The payment may actually be the smallest part of the housing burden. And third, the cost to stay. Refinancing means paying closing costs, typically somewhere in the range of $4,000 to $7,000 to remain in an asset they may ultimately be better positioned to exit. That's money that reduces what they'd net from a future sale. None of those factors alone makes the refi wrong, but together they suggest a different question worth asking. What is this house actually worth, and what would selling it make possible? Based on comparable sales in the area, Fred and Betty's home may be worth somewhere between $600,000 and $800,000. Let's look at what that may actually mean for their net position, because this is where the conversation completely changes. Even at the conservative end, a $600,000 sale, they may walk away with somewhere around $339,000 after paying off both mortgages and covering selling costs. At the stronger end of that range, closer to $529,000, that's not a mortgage problem anymore. That's a strategic asset, and here's what that liquidity may be able to do for them, especially if they've been thinking about relocating to be closer to family. Let's say rent in their target area runs $2,000 to $2,500 a month. Their $8,500 in guaranteed monthly income still covers that comfortably with room to spare, and that net equity from the sale? At this stage of life, it tends to serve a really important function. It becomes a healthcare and longevity reserve. Money that's accessible, flexible, and not locked up in a house they may eventually need to leave anyway. There's one more element here worth mentioning. Fred and Betty were thinking about relocating to be closer to a family member who also happens to be the person they've named as their executor and successor trustee. Being geographically close to the person managing your affairs as you age, that's not just a lifestyle consideration. That can be a meaningful element of a late-stage financial and estate plan. At 74 and 75, renting near family may tend to offer more optionality than staying in a large home with a fresh 30-year mortgage. It's worth putting the numbers on the table before saying yes to the bank. I want to be transparent about something because I think it matters. I don't prepare tax returns and I don't provide legal advice. My role is to coordinate with your CPA and your estate attorney so that your financial strategy is integrated with your overall tax picture and your estate plan. The analysis I've walked you through today is an educational illustration, not a recommendation. The right approach for any situation depends on the full financial picture, tax position, family dynamics, health considerations, and personal goals. That's a conversation that deserves more than a YouTube video, but this framework is a solid place to start. Here's something worth sitting with, and this applies to whether you're in your 50s watching this or you're helping an aging parent navigate a similar situation. The most dangerous financial moves tend to be the ones that look obviously right on the surface. A lower payment, a fixed rate, a clean solution to a messy problem. The families who tend to make the best decisions are the ones who pause long enough to ask, what's the full picture here? What does the equity represent? What does the next 10 years realistically look like? Fred and Betty aren't in a bad position. They have income, they have equity, and they have options. The goal of this case study isn't to say there's one right answer. It's to show how asking a different question may open up a much better conversation. If this kind of real-world retirement planning analysis is helpful to you, I'd encourage you to subscribe to this channel. We cover the decisions that tend to matter most for families in the decade before retirement. No fluff, just the numbers and the framework. Now that you've seen how guaranteed income may completely change the math on a housing decision, Fred and Betty's $8,500 a month is what made the equity picture so powerful. Here's the question most pre-retirees haven't fully answered yet. What may your savings actually produce as monthly income when you stop working? Not your account balance, your monthly paycheck. In my next video, I break down exactly what $250,000, $500,000, $750,000, and $1 million may realistically generate in retirement income, using real numbers so you can stop guessing. Watch it next. This video is for educational purposes only and does not constitute personalized financial, tax, or legal advice. All scenarios presented are hypothetical illustrations and are not guarantees of future results. Consult a qualified financial professional for advice specific to your situation.